Well, I don't have a text. I started broadcasting, and I've got 1/6 of the class present today. That's 1 out of 6. Just Clayton. 2 others that usually make 50% is Jonathan and Cole. So, excuse me. We may make class a little shorter today. My sinuses are still bad as they can be, and I need to make a test up for managerial before I leave today. But we're going to look at some problems at the end of chapter 7, itemized deductions. If you would turn your books to page 7-38. So I have the wrong jumpy drive in there. Clayton, is Mercer County supposed to flood today? Are they on a watch? Down my way too. Okay, chapter 7 is where we are on itemized deductions. Down my way, if my house gets flooded, all of Tazewell County will probably be washed away. But anyway, looking at the first problem, this is what we'll spend our time on today since I don't have but one present. Exercise 33, I asked you to look at the evens, but let's look at medical expense deduction. Angela is single, has no dependents. For the year, her salary is $58,000. She pays $600 as medical and dental insurance premiums. That is deductible, which is withheld from her paycheck on after-tax basis. Now, $600, if that's withheld monthly, that's times 12. $67.50 in mortgage interest on her home, and $1,200 in interest on her car loan. Her health insurance provider reimburses her $10,000 of the medical expenses. All right, she had doctor bills $11,700. She had hospital bills of $94,000. She had legal fees and sued against a ski resort. That's not deductible. The mortgage is deductible. Interest on her car loan is not. All right, $600. She pays $600 in medical and dental insurance premium, which is withheld from her paycheck on an after-tax basis. Didn't say how many paychecks she gets, but that health insurance is deductible. So let me show you problem 33. And Clayton, I won't pick on you since you're the only one here. I'd have to ask you every question. Okay. 11,700 hospital bills. I guess that's just $600 total. But her total medical is $21,700. Her reimbursement is $10,000. That only leaves $43.50. All right, less. Okay, wait. 7.5% of her AGI 58 is $43.50. So 10 and 4,350 from 21.7. She has medical expenses then left over of 73.50. Her mortgage now 14.1 is better than her standard deduction of 12. So she'll take the 14.1 from 58. Her taxable income is 43.9. Main point: ski resort lawsuit is not deductible. Health insurance premium is $600. I'd like to have that per month. That's per year. That's ridiculous. Okay, but that's what we'll go by. And it brings out that she can itemize because the standard is less of 12,000. All right, now 35, medical expense deduction. Again, you're supposed to look at the even. We'll look at some of both. Dan lives in Duncan, a small town in Arizona. Because of a rare blood disease, he is required to take special medical treatments once a month. The closest place these treatments are available to Dan is in Phoenix, 200 miles away. The treatments are provided on an outpatient basis, but requires him to stay overnight. During the year, Dan makes 12 trips. All right, that's 12 times 200 times 18 cents a mile. The motel he stays in charges $85 per night. For the year, Dan also spends a total of $250 for meals on these trips. $100 of this $250 is spent while en route to Phoenix. 150 is there. What is this qualified medical expenses? All right, now a couple interesting points on this one. All right, Dan can deduct $1,540 as medical expense. Now his mileage is 12 trips times 400 miles times 18 cents. It's 200 miles each way. That's $864. Lodging, 12 trips times 85. That is limit per diem. They call it at $50 per day. So this is IRS's rule of $50 per day. If you paid 30, you take 30. If you pay 90, you take 50. If you pay 80, you take 50. All right. So his qualified medical expenses. Now his meals, you only get to take 100 en route to, and you only get to take 50% of meals. This is IRS rule. That's just a rule we have to live by. And he only gets to take the meals en route. So he still gets $1,540. A lot of people wouldn't think to take the mileage, they wouldn't think to take the motel, and they wouldn't think to take the meal. Now that's $1,514 besides his medical insurance, his doctor bills, his hospital bills, his prescription meds. And he may have to have special equipment at home. If he does, elevator, a ramp into the house, crutches, wheelchairs. All right. Again, you all do 36, and we're going to look at 37. All right. Carla is a single with no dependents. She's hurt in an accident. Carla is 38 years old. On Tuesday, my son, I think I was telling you about that, he was the first one up on a four-car accident. Some woman, he helped her out of the car, and another woman, he helped her out. He couldn't help her little girl, 10 years old, and they had to take jaws of life to cut out the little girl, and she died. And there's a big write-up about it. I looked it up in the Chattanooga paper. It was also on the TV news for Chattanooga, and there was a vivid sight because he saw a lot of blood. And the mother that was trying to talk to him, her tongue was half cut off, but she survived. but the little girl did not. So, car accident, you never know. Okay, the accident left Carla's legs 85% paralyzed. After incurring $14,000 medical expense, the doctor recommended she install a pool in her home. Now, I wanted to get to this one about installing something like a pool, a ramp, or an elevator. They are deductible, but to a limitation. The pool costs $25,000 to install and increased the value of her home by 22. Keep those two amounts in mind. It costs 25, but only increased the value of her home 22. She also purchased a wheelchair. She spent $930 maintaining the pool and $160 in 2019. She purchased a wheelchair for $2,300. She charged that to her credit card. She paid her credit card bill in January. Now, the point there is, as long as she had on her credit card, it is deductible in the year you charge it, not the year you pay it. She purchased a hospital bed for $3,800, but did not pay for the bed until 2019. All right, that would not be deductible. Carla paid her physical therapist $4,000 for several surgeries performed in 19. She paid $1,200 medical insurance premiums on an after-tax basis. All right. The insurance company reimbursed Carla $9,000 for her hospital stay. Her AGI was 38 and 43. Now look at the interesting points. The points this makes. This is number 37. She gets to take the hospital bills, of course, but then she has to take out the reimbursement later. Success cost of pool over increased value of home. You get to take the difference. You don't get to take the 25 or the 22, you take the difference. Now, if she installed that pool for 25, it increased the value of her home by 10, she could take the difference of 15. Maintenance of the pool, now this is 2018. Maintenance of the pool in 2018 was $930. Medical premiums $1,200. Wheelchair $23. You take 7.5% of her $38,000. Subtract the 12. You know she's going to itemize. 18,580 is better than 12, so she's going to take 18,580. Now B part. In 1919, Carla must include 6580 reimbursement of taxable income to the extent that it provided a tax benefit. Well, it did provide a tax benefit because if this was 12 and this was 13, then the tax benefit would only be $1,000. Take out that reimbursement of 9, less that 7.5% of AGI, total medical. 2018 went down, of course, to 95.80, and in that case, you use the standard deduction. It's bigger. It is bigger because of that reimbursement. In 1919, she takes the fees paid to the therapist, the hospital bed, the medical insurance, the pool maintenance. That is only $10,063. She takes her 10% of AGI. Now it's 10% now in 1919. And her official medical expense deduction is $5,102. $50,102. Now that may help her itemize, that may not. You add other things to these itemized deductions. You add interest, you add state income tax, you add charitable donations. So yes, she still may be able to itemize, but we're looking at the qualified medical expenses. Now we'll fill out a Schedule B later. Okay, 39, taxes. Okay, that's the second item. All right, if you would, go back a page, look at page 735. Go back 2 pages. Clayton, can you go back a page easy on your ebook?
Yeah, I'm already
on.
The Schedule A.
Yeah. Some of these accounting principal students, their ebook, it sucks. But they got to go back to the table of contents and click on it for it to take them to the problem. Then they can scroll down to the problem. They can't do it by page number. But Clayton and everyone else, when you look at our doors to our classroom, if you see this schedule, Clayton,
Have a look.
it's 8 classes that are going to be offered. It's 6 classes going to be offered for 8 weeks. It's all online. If you need to add another class this semester, now like Georgie, he's got 24 credits. He's in 2 sports, and he's working, and he's tutoring. If he asked me to add one of these classes, I'd throw a book at him because he's already overloaded. This is in case you're not overloaded. If you dropped out of a class or you need another class, then you might want to add one of these. There is, for accounting majors, computer information system, that's QuickBooks Pro, and there's international business, production operation management, e-commerce, principles of management, and human resources. Now, accounting majors need principles of management. Probably already had it, right? I don't know if accounting majors needs production operation management or international business or not. Might need one of them. Now, you definitely don't need human resources, and you don't need e-commerce. All right. E-commerce is in a new program we have called Entrepreneur, which Miss Belcher is teaching a couple of classes in it. I guess it qualifies you to be an entrepreneur if you want to start your own business. So does small business management. Any of our degrees can help you start your own small business. Okay. Now let's look at the Schedule A that you have in front of you. If you're at home, look at page 35. I guess that's page 35. The first part is medical. That's what we're looking at. Now we're going to start part 2 on taxes. Then we're going to get to part 3 on interest. Then we're going to look at gifts to charity, part 4. And then we'll look at some casualty and some other. Now, the first 4 are the biggies that helps people itemize. Medical, interest, charity, casualty. These miscellaneous don't amount to much. All right. So now we're going to look at the second part, taxes. And the problem I wanted to look at is an odd problem, deduction of taxes. All right, Dawn is a single cash basis taxpayer. She paid the following taxes in the current year. Her employer withheld $5,400 for federal income tax, $2,000 for state, and $3,800 for FICA. Dawn purchased a new car and paid $600 in sales tax and $70 for the license. The car's fair market value is $20,000. And it weighed 3,000 pounds. The county also assessed a property tax on the car. The tax was 2% of the car's value and $10 per hundredweight. Dawn used the car 100% of the time for person. She sold her home in April. All right. The county's property taxes on the home for the year was $18,500. Okay, payable in February. Now, Dawn's AGI for the year is 50,000, and her other itemized deductions, don't count the taxes, is 8,000. So her other itemized deductions would be medical and interest and charity. So let's look at her taxes. All right, she gets to take the state income tax. You know you cannot deduct federal income tax or FICA or Medicare. FICA is Social Security and Medicare. You don't deduct them. All right, her property taxes on the car is 2% of its value. That's $400. You can deduct personal property tax. You can deduct real estate taxes on the house. It was $1,850 for the year, but she moved out of it on April, whatever. What day did she move out of it in? On Clayton?
15.
On the what?
April 15th.
All right, January has 31 days, February usually 28, March 31.
Well, it says she sold it on that day. Does that mean she moved out?
She sold it? Yeah, 15. All right. Now I'm getting 31 days in January, 28 days in February, March 31 days, and it said April the what?
15.
Now, if I add those together, 31, 28, 31, and 15, I get 6, 7, 8, 9. I get 105. Do what?
I got 104.
I believe 105 is more correct. You do count the day she moved out. They may be subtracting that day. She sold her home on April 15th of the current year. She sold it on April 15th. There must not be counting 15 days in April. They're only counting 14. I don't think one day here IRS would hang you. If you got it right or if you got it wrong. She will report this deduction on 1040A. Now that's taxes. And that's pretty much what you're going to deduct. State income tax, personal property tax, and real estate tax. That's pretty much it. Okay, we'll look at that, some evens later. We're going down to 47 or 41, interest expense. On January 1st of the current year, Scott borrows $80,000, pledging the assets of his business as collateral. He immediately deposits the money in an interest-bearing checking account. He already had $20,000 in this account. On April the 1st, he invests $75,000 in a limited real estate partnership. On June the 1st, he buys a new ski boat for $12,000. On August the 1st, he makes a $10,000 capital contribution to his unincorporated business. He repays $50,000 loan on November. All right. Classify. Okay, now some of this is going to be pure personal, some of it's going to be business, and some of it could be itemized deduction. All right. Investment interest is on his investment. Now, here's some more investment interest from April 1st to June. Some passive interest. Passive, passive, passive. He did not buy a house. So there's no mortgage interest. The boat, you cannot deduct interest on that boat, whichever one this is. But you can deduct this investment interest in a certain place I have to show you later. We're going to look at 43. During the year, Tina purchased a beachfront house for $600,000, paying $150 down and taking over $450,000 mortgage. Now she can take all the interest on that beach house up to, it could cost up to $1 million. It didn't cost $1 million. The outstanding mortgage on the resident is $700,000. Now, did she assume that? This debt is secured by the resident. Fair market value of the principal resident is $1,400,000. She did pay more than $1 million if she assumes that loan. This was complicated. Crown can deduct the entire interest accrued because it and BJ Partnership are not related parties, but she may deduct interest on a total in debt of $750,000. Well, I got to read that again to see how that went. She paid $150,000 down. She took out a mortgage of $450,000. That's $600,000. At the time of the purchase, the outstanding mortgage on her principal residence is $700,000. Her principal residence was $1,400,000. So she's buying a new residence. So she may deduct interest of $750,000. She is limited to interest expense deduction. All right. Thus, Tina may deduct interest paid on the $700,000 secured by the principal residence and $50,000 of the debt to buy a condominium. So the limit is $750,000. That's where we're at there. The limit is $750,000. Huh?
It's not $1 million.
Not $1 million. See, she bought a second home. Her principal residence, she could take all of it, that's $700,000 up to $1 million. All right. But IRS in 2019, there used to be no limit. Now they're going to limit $750,000. That's Trump's plan. So I just see that now myself because some of those new laws, they didn't spell it out, but that is spelled out for us. $45, timing of interest deduction. Well, pay all your interest. You know, if you want to deduct interest, pay it by December 31st, credit card or cash. If you want to deduct a charitable donation, pay it by December 31st, credit card or cash. A lot of churches, their donations go up in December because people are catching up or they want a tax deduction. But now your interest deduction, it depends on how your loan is set up. Clayton, you're not in finance, are you? Haven't had it yet? So I've taught this before, but I don't remember how to set it up. I need to set up an amortization schedule for a loan at a certain rate, payment a certain amount a month. I mean, I've done that before, but I need to set them formal and get somebody to put it on a computer and run out the whole schedule. All right, let's look at 46. During 18, Doug incurs the following deductible expenses: state income tax, local property tax, medical bills, charitable donation. All right, it has no dependents and has 35,000 EGI. What is the amount of Doug's taxable income? Well, that's just itemized deduction. Number 45, Doug could take all of those. Is that Henry? Let's time in 46. And now Doug can take the medical expense. They don't get any. Time you take out 7.5%. You can take all the state income tax, all the local property tax, all the real estate tax, and all the charitable donations. But still, 12,000 standard is better, isn't it? That's why it's going to be harder for people to itemize this year. It's going to be harder for me to itemize. Okay, I'm going to give you a minute, Clayton, to do A part of number 47. Take a minute and see what you can come up with on A part for number 47, and you at home do the same thing. Okay, I gave you a moment to look at that, Clayton. I still won't pick on you. But anyway, his income consists of the following: salary, you have to add interest; long-term capital gains, you have to add, but you could take the losses. So 15 from 23 would be 8. All right, but that's still added in to taxable income. Now you can take the medical expenses. Now you can take the residential interest of 12. You cannot take the 2 personal loan. You can take the 3,000 to charity. You can take the 7,000 state income tax paid. You can take sales tax if you want to take the state, but you want to take the state. Property taxes 4. You want to take tax return preparation fees 5,000. So here, your big question is, where's the $5,000 go? And how about that investment interest expense of 14 and other investment activities of 15? Now, that's a lot of expense, and you only made 8,000 long-term capital gain. So let's look at number 47. I want you to look at the deductions. Salary, interest, and 8,000, as I told you, that's 85,000. All right, medical, you're going to take the 8, but you got to take out 7.5% of the 85. That left 1625. Now, qualified residential interest 12, charitable donation 3. Now, I want you to look at these two. Oops, the 10. Taxes is lesser of. Now, let's see where that 10 comes from. State income tax paid 7, right? And they're letting you add up to 4,000. Let's see that. Wait a minute. Taxes.
I guess you can only take it.
Yeah, but taxes, state income tax, 7. State income tax, 7. And property taxes, that's personal property taxes. And Trump's new law is limiting us to 10. Now, that's what New Jersey and New York residents were complaining about back when that law was going to be passed. It was taking away some of their state tax deductions. Well, I'm okay. I pay a lot less than $10,000 in real estate and state income tax and so on. Trump is limiting that to 10. All right. Now, this one, you can take the 15,000 investment interest if you had 15,000 income. And he has a long-term capital gain of 23. So that takes care of the 15. You can take the 15. Investment interest expense, 16. Other investment activity expense, 15. All right, other investment activity expense. It did not say interest. But here, investment interest is limited to net investment income of 15,000. Now, where did that 15,000 come from? Well, here it says 7,000 divided by 8,000 net capital gain. That'd be 7/8.
No, that's a plus.
The one? Oh, that's a plus. I'm sorry. 7,000 interest. I was overlooking that. The interest income, that's investment. And 8,000 capital gain, that's your 15. Yeah, I was overlooking something different. Okay, then. Let's look at a couple of charitable contributions. Now, charitable donation, you can deduct up to 50% of your taxable income. But let's look at 49. Donna is an attorney who renders volunteer legal services to a legal ad society. All right. Now, during the current year, she spends a total of 200 hours as volunteer work. Her regular billing rate is $3.50 per hour. In addition, she spends a total of $800 out-of-pocket costs in providing these services. She receives no compensation and is not reimbursed. All right. She has very little deduction, and I want to show you on number 49 that you cannot get a deduction for your services. She has $800. She cannot deduct the value of her services. We're going to look at number 50. Please note these number 50. Now, these are some of the last biggies, but I want you all to try to do problem 59 by next Thursday, a week. 59 is your tax strategy problem. 59, you'll need the 1040 AB. You'll need the AB and the 1040. Okay, that's for next Thursday, though. We'll try to wrap up a lot of things Tuesday. So in the meanwhile, be working even problems on this chapter. We've looked at a couple of them, but not all. So we're going to look at problem 50 and 51 and 53 today. And we're going to call it today. Okay. In each of the following independent cases, determine the amount of the charitable donation and the limitation that would apply. Sharon donates a tract of land to a charity donation. She has held the land for 7 years. That makes it long term. Her basic land is 10 and the fair market value is 40. All right, two deals there. If she wants to apply the 50%, she might can take the 40. If she applies the 30%, now this is number 50, I guess. If she applies the 30%, she's going to take the 40. So I would take the 40,000 if it's 30% of my gross income. Now, what is her gross income? Did it say? Didn't say. But 30% of 100,000 would only be 30,000. Then she could only take 30,000 there, okay, instead of 40. So if she had 200,000, 30% is easy over 40. But now B part, assume the same facts except that Sharon has held the land for only 11 months. That makes it short term. If it's short term, you take the basis, which is 10. Short term, the base is 10. If it's long term, you can take the fair market value of 40. With the limits. C, Jack purchased a historical document for 30. He donates the document to a charitable donation 2 years later. The organization plans to use it for research and study. Now, its fair market value at the time of donation is 100. Its fair market value is 100. She paid 50. All right. Her charitable donation is 100,000, subject to limitation of 30%, because she's getting the fair market value, isn't she? She's getting the fair market value, but she got a limit to 30%. Assume the same facts, except that the organization plans to sell the document. Then its limit to her cost, 50. Anytime you use cost, you can use 50%. And E part, Valerie donates some inventory to a charitable donation. The inventory is not food or clothing. The inventory is purchased for $300, and its fair market value is $1,200. All right, or is that $500? $500. Now, if you donate inventory, you can only take its cost. Okay. That was number 50. 51, real quick. We'll look at that one come Tuesday. And I also want to look at 53 come Tuesday. And we'll be wrapping up the chapter on itemized deductions. Now we're going to go back Tuesday and look at a few things in chapter 5. And we're going to be looking at chapter 7. And we'll soon decide another test. And Clayton, thanks for being here. I'm going to dismiss class early because my sinuses are starting my coughing again.
We'll go over the schedule D.
Yeah, we'll go over the Schedule D Tuesday also. There's not enough here today to go over it, so Tuesday.